as usual, right? We do two of these at least a month, and regularly scheduled with Brenna with Land Title, and then Mitch with Pivot Lending Group. Title and mortgages are two of our primary partners here in real estate. So we want to bring relevant information about what's going on in mortgages directly to you, because there's a lot of questions around it. In fact, Mitch and I were just talking offline before this started. I had a question from another real estate agent partner that I know that was asking about mortgages, and she said, "Hey, what do you know about this?" And we kind of talked through a couple different options. So,
right.
Mitch,
yes,
go ahead and introduce yourself for those that may not know who you are, and a little bit about your company.
You got it. Thank you. Thanks for the continued inviting. It's always fun to join and talk about relevant mortgage information that pertains to our marketplace. And as our marketplace changes, sometimes on a daily basis, it's important that we adapt and have the tools to use so our clients can continue to buy homes and make it affordable to do so. So I've been a mortgage banker for the last 33 years, 28 of those years in Colorado. I work with a company called Pivot Lending Group. We are based in Littleton, Colorado. As I mentioned, we're a banker or mortgage banker, so we can handle the loan file from the very beginning stages to interviewing our buyers about what kind of loans they qualify for and what's going to work for them, all the way through processing. We underwrite the file ourselves and approve it. We provide all the final loan documents. We fund the loan ourselves, and some of our loans we actually service as well, which means the buyer pays their payments directly to Pivot Lending in Littleton. So we are definitely the kind of one-stop shop type of mortgage banking company that is based here in town. And so they've been around for about 20 years as well.
So the advantage that you see or that you have over a mortgage broker, and if you can kind of define those terms, what do you see as some of the advantages and why you've gone that route with partnering with Pivot?
Sure. Yeah, thank you. It's a great question, because that's the only route I ever knew when I first got out of college and started mortgage banking. And then I learned what it meant to not be a mortgage banker. And what I found was that the lines of communication are much different, because it's my team all the way through the transaction. I always know who I can call. I can get a quick answer. We can adjust and adapt as we need to and be very nimble, especially in this marketplace, which is so important to be able to do that. And then get back to our clients with answers or make those changes very rapidly and still be able to close on time. So that's the biggest piece that I've seen is the difference. And I've never seen it to be more important than right now, because of having to move so swiftly with our closing dates. A 21-day closing has become the norm all of a sudden. And you need a team behind you that you can go to every single moment of the day to make sure everybody's on board doing the same thing for our clients. So that piece is a big piece. There's other nuances around it. What we do is very similar to a broker, which is why a lot of people talk to brokers, is because they think a broker can shop their interest rate around for them with different investors. So we do the exact same thing. We just have the authorization by those investors to actually be able to underwrite, fund, and close the loan. And then we transfer the servicing to that loan to that investor after the loan closes. So we actually offer the best of both worlds, is how I speak with my clients when I give them the comparisons. And there's no middle company in between me and the client. And so it makes a difference, in my opinion. It makes my life easier, and it really helps our clients navigate through the transaction.
And I think, having control in that process allows your company to make decisions that make sense, but they may not fit into the box, right?
Correct. That's very much so.
Yeah.
And we can make them in a 2-minute phone call. I don't have to wait for an email to come back or a phone call from another company who is underwriting a file like a broker does.
Yeah, somebody told me a long time ago that just because you got a no from one lending institution, one lender, doesn't mean that's a no across the board. So, sometimes it does take finding somebody who's got resources like Mitch, who can find a way to say yes.
Right? Correct. Well, we do our due diligence, and the fun part of my job is not collecting bank statements from people and asking where their money came from. The fun part is when we have to put the puzzle together and there's a missing piece, how we find that missing piece.
Yeah,
that's what really is where my value comes in the many years I've been doing this.
Yeah. And hugely beneficial. So let's jump into our topic here a little bit,
Sure.
Mitch. We're going to talk about jumbo loans. And I thought this was a relevant topic because the prices in the Denver metro area have gone way up. I mean, seems like almost the average home now might be fitting into that jumbo loan criteria. Um, just my joke around it, but the prices have gone up. So, talk to us about what is a jumbo loan. What does that look like for those that are unfamiliar?
Sure. So the jumbo loan terminology was created, any loan that exceeded the Fannie Mae typical loan amounts, and they're different in every county, is considered a jumbo loan. And so a jumbo loan is usually a loan that is going to be somewhere between $685,000 and $745,000. So when you start exceeding those levels in different counties, all the Denver metro area counties, you can borrow on a Fannie Mae loan up to $684,250. So anything above that by $1 would be considered a jumbo loan. And so the jumbo loan loan is basically a loan that allows someone to borrow more money. And usually jumbo loans are more in the $800 to $3 million loan amounts. We tend to be able to work with some of the levels of loans that are close to Fannie Mae limits and close to being a jumbo loan. We have different avenues to get it back into the Fannie Mae loan limit if it makes sense, and we need that for qualifications. But the jumbo loan category has become, it's more restrictive than a Fannie Mae loan. And we'll talk more about that and some of the guidelines around that. But the jumbo loan just allows somebody to borrow more money than the Fannie Mae loan limits. So that's really what a jumbo loan is. That's how it starts.
Yeah, so for a jumbo loan, is lenders lending more money? Are they looking at that as, hey, that dollar amount is a lot,
Mhm.
so maybe there's more risk if they go into default, it's going to hit us harder. So is that kind of why they want the break in pricing and say if it's above this, we just consider it a different risk category?
Yes, yeah. So Fannie Mae is a government-backed owned entity, and the government doesn't want to back jumbo loans. That's not their goal in creating. Well, they took over these entities; they didn't create them, but they wanted to still be able to provide financing so it's affordable for people from a standpoint of lower down payment or using more of their income to qualify or more flexibility in credit scores. Jumbo loans are much less tolerant to a lot of those different features of a loan. And so they are a separate entity, but they're also a lower risk client because you must be much better qualified to qualify for them. And so there we do a lot of them. We make a lot of jumbo loans for the reason exactly that you mentioned, that the price of homes have gone up so much that that $700,000 house is now $1 million, and that becomes a jumbo loan if you don't have $350,000 for your down payment. So,
Well, and if you just sold a house in the same market, you may have that 350,000 down
exactly, for
to
sure.
put to it. So you mentioned the qualifications. Who qualifies for it? What do they need to qualify for it?
Sure. So anybody can qualify for a jumbo loan as long as they meet the guidelines, the criteria, which are going to be, like I mentioned, a little bit more restrictive than a Fannie Mae loan. So for one example, jumbo loans say we can never use more than 43% of the borrower's monthly gross income to go towards a new house payment and any other monthly bills, excuse me, monthly bills that they have, where Fannie Mae will let you go up to 49.5%. So that 6% is a huge difference in many cases for qualifying. But when you take it out, it also is a huge difference for qualifying on a jumbo loan. So oftentimes we're working with people who have a fairly significant monthly income. That 43% is a large amount of their income that allows them to qualify for a higher loan amount. Credit scores need to be a little bit higher. Ideally, they want them to be 760 or higher to get the very best interest rates. You can go all the way down to 680 on the credit score, but that would be a big impact to the interest rate and the amount of the loan that the borrower can borrow, because your credit score also determines how much money they'll let you borrow. A Fannie Mae loan will let you borrow any loan amount as long as it's within the limits with any credit score as long as you qualify. Jumbo loans are not. They have tiered levels with credit scores and down payments. So typically a jumbo buyer is got very clean credit, very stable jobs, or self-employed, making pretty significant income, and they have typically a 20% down payment. It's not required to have a 20% down payment, but typically those buyers will apply a 20% down payment because we can do a 10% down jumbo loan. They're just much more expensive in the interest rate.
Yeah, so with the increase there in kind of what they're looking for down payment,
yep.
What kind of reserves does a jumbo loan borrower need to have, right, in place?
Yeah, so it's more. So Fannie Mae, I always use them as comparisons. I think it's good for people to understand the difference. Fannie Mae loans have oftentimes no reserve requirements if it's your primary residence. But on a jumbo loan, a reserve, number one, is money left over in a bank account or a retirement account or a stock account, any asset that could be liquid, that is verifiable after the borrower applies their down payment and covers closing costs. And so the reserves have a per month amount that has to be met. So if someone's house payment is $4,000 a month, there's going to be either a 6-month reserve, so 6 times $4,000 or $24,000, or a 12-month reserve, which would be $48,000, that the borrower must be able to show separate from down payment and closing costs. And oftentimes we're using people's stock portfolios, 401ks or IRAs. They're not liquidating any of that. We just have to show that it's available should they fall into some hardship and they can actually withdraw those funds. But those requirements are not there for Fannie Mae loans, again, as a primary home. Rental homes for Fannie Mae require reserves also, but not on primary.
Yeah, so looking at, kind of this age-old wisdom, right? To set aside money for savings and or investments.
Yes.
If you're looking to buy luxury homes, that's a good place to start, right? Start saving your money because you're going to need some cash reserve just in order to qualify.
For sure, and it's important. Like you're alluding to, is if you're going to have a $4,000 a month or $5,000 a month house payment, what if? Like, well, the what ifs need to be thought about so that you have some backup. And so that backup money does make the jumbo investors feel more comfortable with offering financing to people beyond the Fannie Mae loan limits.
Yeah. So interest rates now, right, as somebody that's not in mortgages, right? Again, what we do is attached to, right? Just I'm assuming interest rates are going to be higher for a jumbo loan, given the amount of money, the things that are involved, and that. So, what are the interest rates by comparison?
Yeah, it's a valid thought because most people do think that. They think the jumbo interest rate is higher than the Fannie Mae interest rate because Fannie Mae is protected by the government, whereas jumbo loans are not. Many years ago, it was true, jumbo loan interest rates were higher, but over the last 3 to 4 years, jumbo interest rates have become lower than the Fannie Mae or Freddie Mac or even sometimes FHA or VA loans because the client is a less risk borrower because there's more stringent qualifications required. And so the risk factor is everything when it comes to interest rates. So somebody is a less risk in the eyes of the investor for the type of jumbo loan, then they're going to offer lower rates because they feel that that person's chances of going to default could be less than someone else's. Yeah. So they're actually right now, they've been in the range of 0.3% to sometimes 0.5% lower than a Fannie Mae loan, which most people raise their brows to and go, I did not know that, and I would have never known that.
Hi, my name's Matt. I did not know that. I would not have known if it wasn't for Mitch sharing that.
And tied into the rate side of things is a lot of people who are buying in these higher levels or higher price ranges are considering adjustable rate mortgages again, because as mortgage rates have escalated, they have found that their money being tied up on a home loan at low rates is better for them. And so we're finding we're using our jumbo adjustable rate loans much more frequently right now. And those interest rates are about 0.5% lower than the 30-year fixed rate loans. And so we're in the 3.375, 3.5 range for a 7-year adjustable rate mortgage, where the rate's fixed for the first 7 years. And for a lot of people in the higher jumbo range, sometimes they're going to pay them off in 7 years. And sometimes they're comfortable because they know how adjustable rates work and their income levels can support the adjustment, but they really enjoy the lower discounted rate at the very beginning.
Yeah, so, as we talk about interest rates being up to 0.5% lower, right, there's a correlation into your monthly budget as to interest rates and values of the home. So 0.5% is worth 5% of the value of the house, right? So I'm thinking about it. Hey, if we're searching near the jumbo level, well, I might be able to step up a little bit in house and get into the jumbo loan and actually keep the same monthly payment by buying a more expensive house.
Exactly. And when somebody's that close, we have that conversation with them. Like, hey, you're right at that borderline. If you spend another $30,000, you could, maybe $25,000, you could have the same payment or very similar payment as if you bought a little less expensive home, just because the rates are lower for the jumbo loan. Yeah, it's an interesting thought, but it's a reality.
Yeah, again, as we're playing chess in this game, not checkers, being able to move things into your favor, because sometimes the difference in that house for an extra $25,000 may be worth it. Right?
Yeah. And as I'm having the conversation with our buyer clients, that's what I will think about. That's what I'll share with them. We never want to, I hate the term is upsell, right? We never want to have somebody go to a place that's not comfortable payment wise, but if the payment's very similar and they could buy a little more expensive home, I feel like that's my job, is to make sure I share that information with them.
Yeah. This is me, Mitch. If we're having that conversation, I'm going to tell you, I'm always fine buying a nicer asset if it's going to cost me the same amount of money.
As you should.
Right.
Yes.
Now, when I say same amount of money, right, when you factor what the payment is over the course of 30 years, the budget's going to come down to about the same. Right. It's not going to matter all that much in the grand scheme of things, right? The monthly just budget stays the same, and you get something nicer. Right?
Correct. Another thing that came to mind with payment, usually people, again, are putting 20% down on jumbo loans, so there's no mortgage insurance involved, just by default, because there's 20% down. But we can do, as I mentioned, a 10% down jumbo loan. You can't borrow $3 million with 10% down. You could borrow about $750,000 with 10% down. But then there would be mortgage insurance introduced into the payment at that point.
Yeah.
So we have to keep an eye on all moving parts as we guide our clients to what information is available to them.
Yeah. Always a lot of different factors at play, right, as we increase or change the numbers. So where might somebody want to avoid getting into a jumbo loan and stay in kind of that Fannie Mae limitations?
Well, that's a good question. So what comes to mind as an answer to that would be looking at doing a first and second mortgage at the same time, where the client may not meet the criteria for a jumbo loan as far as the 43% debt to income ratio or the 12-month cash reserves or reserves in an account somewhere, where Fannie Mae may not have that same criteria. So we could take a $1 million home and we could do a $684,250 Fannie Mae maximum loan amount first mortgage, and then a $100,000 or I have to run the numbers. Let's say $140,000 second mortgage, and then the buyer puts 10% down, and we eliminate the need for, one, mortgage insurance. Two, we're not in the jumbo loan qualifying category, so the buyer can use more income to qualify. Three, we don't have to worry about the high reserve requirement that jumbo loans require. And so that's our solution to that scenario should that come into play. Or if somebody only wants to put 10% down on $1 million home, that's the other option for them instead of having to do a jumbo 10% down loan that's much more expensive and pay mortgage insurance. We could bypass all of that with that first and second loan option. So that's what comes to mind with your question. Really no other reason to avoid a jumbo loan unless you just don't have the 20% down where it makes sense or you need it to qualify.
Now, if interest rates start to change in that jumbo market, it may become still more advantageous at some point to do that. But do you see jumbo rates kind of bypassing and going up above the conventional loan limits at some point in the future? Or do you think they're down and going to stay down?
I think they're going to stay down for a while unless something drastically changes where they see a lot of defaults or things, the market not holding and there's some concerns about valuations. I don't know if they'll change the rate. They may sometimes change down payment requirements or other qualifications to tighten that up. But I don't see rates changing because, again, they're large institutions who offer these jumbo loans, and they need to place their money somewhere that they feel is a safe asset, and they feel real estate was one of those safe assets. And they're just qualifying people very, very tightly and very securely to qualify for the jumbo program. So I don't think that'll happen for a while, if at all.
So again, going to go back to the qualification there of the buyer, the individual, mm-hmm. It doesn't make sense to stay in, jump out of that jumbo option.
Yeah, and again, if they're close, then we'll figure out what's the best solution at that point.
Yeah.
To that loan amount.
Yeah, the interest rates have had a big impact, and they've been volatile as of late, not just in the jumbo, right? So just across the board, they've been going up.
Yep.
So, I've been hearing this, and we're going to divert topic here for a little bit, just because I believe it's relevant right now for it, and impacting even jumbo loans and real estate prices. But I've been hearing for a very long time that I'm just going to wait for the housing market to crash, the bubble to burst, and prices to come down, so that I can buy a house. So you and I were chatting with a mutual client here this week, and they were chatting with you last summer and running numbers as to where they could qualify for. With the rise in interest rates, they lost about $100,000 in buying power.
Yes, they did.
So even if the market had a big correction and things went down, I don't think we're going to see in that short amount of time a 25% drop. But that's kind of the impact that it had for them, specifically when it came to their price point.
Right. Yeah, it was a very big impact and a bit of a shock to them. And the rates went up, if I recall, we were up about 1.5% 2 days ago. It's now 1.75% because rates went up again today. But they definitely were. They were in the right spot at the right time to consider buying last summer. Unfortunately, they weren't able to pull the trigger at that point in time. In revisiting, it was a challenging conversation because they still want to buy a home, and it's going to make it more difficult now.
Well, last summer, unfortunately, the homes in their max price point today, if you were to look at those last summer, they were not at the same price. They were significantly less because the cost of homes has gone up. So cost of homes have gone up. The cost there of the interest rates have gone up. So significantly different landscape if you're looking from last summer to this year. Now, bringing this up because you said interest rates went up again today. Mm-hmm. I heard on the news that the Fed intends to raise rates again to slow down the inflation.
Correct.
So if we look at this flash forward 12 months from now, how big of an impact might that make in the housing market and what somebody can afford at that point?
Yeah. So the mortgage market predicts and makes assumptions well in advance of the moves of the government as far as the kind of rates that they move today. So our rates started going up about 6 months ago, and everyone was shaking their head saying, why? I don't see anything changing. What's going on? Nothing's changed. We're still dealing with COVID and supply chain and all the things. Well, one, inflation reared its ugly head for sure. And two, the market felt when the Fed said they were going to raise rates, they were all over it and starting to react 6 months ago. So I think as long as the Fed doesn't do anything out of the ordinary or what they've already shared with the markets that they're going to do down the line, then I think rates will probably kind of flatten out in this range. And I'm thinking now this new range, 4.25 to 4.75. Still phenomenally low, historically low rates. However, the stories you'll hear at cocktail parties are, I have a 2 1/8 interest rate. What are you getting today? Right? Which actually has caused the real estate market to not have enough inventory because people don't want to lose those rates and they don't want to sell their homes. There's some people holding back for that reason. But they're still wonderfully low, and they really haven't caused the majority of qualified people to not want to buy. It's definitely impacted first-time home buyers who were hoping they could afford to buy something and they just got priced out, unfortunately. But I think if rates stay below 5, maybe 5.5%, we may not see a big impact in the market. But I think once you get there in the 5s, maybe even 6, I don't think we'll hit 6, but if you get there, I think that's going to cause pause for people's pocketbook to say, wait a minute, this is out of reach now. I've got this 50% more expensive home from 3 years ago, and I've got rates doubling. I don't know if I can afford that anymore. So I think that might show a pause in the market. But right now, we're thinking the Fed's going to do what they're going to do. They're going to raise rates 5 or 6 times maybe in total for the year. And I've heard 7, but I'm more on the 4 to 5 plan. And I think if that happens with no surprises in between, we'll see some stabilization of rates, I think, going forward. We just had to get through today, make sure they weren't going to do something that would surprise the market. And then you have the geopolitical issues going on that are real, that are another headwind for inflation. And will not bode well for all rates in general. So that's another outlier that could definitely have some impact, though, on the rates outside of what the Fed does.
So I think stability in both price rate increases and mortgage interest rate increases would be welcomed.
Without a doubt. And it just feels better to participate in a transaction when it is that way. Mm-hmm. From all parties involved, us in the industry, the buyers having the ability to negotiate a contract. God forbid they do that these days. It's like there's no negotiating. You either want it or you don't. And we'll do our inspection and come back if we need to. But beyond that, it's kind of a seller's market and has been so for so many years. Yeah, so it's almost the norm now, really.
Yeah, very much so. So we'll see what changes are coming down. So again, Mitch, as we wrap up our conversation on jumbos, I think it's a conversation that more folks should be open to as they look at, some preconceived ideas around jumbo loans or mortgages or the real estate market sometimes don't line up with the reality of what's going on today and why it matters to have the conversation with a true professional like Mitch.
Yeah. Well, the first thing, if I say to someone, we'll have a conversation and they're in their higher price range, the first thing they say is, I don't want a jumbo loan because I don't want to pay higher interest rates. Mm-hmm. And that's the familiarity they have with what it may have been years past, or maybe when they bought a prior home, it was that way. So it's important that I bring them current with what's happening now, and they are wonderfully surprised. And then, of course, their game plan changes. Like, you mean I can buy $1.5 million house now instead? and my rate's going to be lower? But this is good. I like this. This is good information. Yeah. So I would say for people thinking about whatever they're buying, just ask the questions. Be open to what the information is. You'll get all the current data from a professional lender who's got some good experience, and help them navigate through what their choices are. and make the best decision going forward, because the financing is probably the biggest key to buying a home if you don't have all cash, to make sure that it's affordable in the long term and stays within budget. And the last thing we want people to do is wake up and go, I can't believe these guys put me in a mortgage that I can't afford. That is not something we will never do for the information we have that we're working with now.
Well, Mitch, I've known you and we've worked together for so long. What I know is that, you know, you're not tied to one particular outcome for any one individual, right? You're here as a general to help people with the best information. So it's not like you're going to say, hey, I make a little more commission over here. It's not as good for the client, but I'm just going to steer them that direction. You know, for your job, for your role, you're very passionate and you take the client's needs very seriously, which ultimately ends up putting them in a scenario that's best for them, simply because you had the ability to ask the questions and put them in the best program for them.
Right, right. I appreciate that. And it makes our job really easy when you're just honest with everything up front. And I think the fact that I've been able to do this for 33 years speaks to that philosophy works. And if I can't do something, I say I can't do it. Or if I tell a client you shouldn't refinance because the rates aren't low enough from your current rate, they would say, I've never had someone tell me I should not refinance because I know that's how you make your living. Well, it's not in their best interest. Why would, I mean, they'll figure it out at some point. Why should I put them in that situation?
Yeah.
And I know you operate the same way in your business. And that's why, one, we worked well together, and that's why our clients continue to call us back to work together.
Yeah.
And if you do the right thing always, at least from what you know in the moment, then that's all we can, that's what we have to offer.
Yeah. Do the right thing in the moment and make sure you're looking out for the consumer's best interest.
Right. Yeah. And there are clients, and the cliche client for life is really valid if you continue to look out for their best interest every time you do business together. So, yeah, and it works.
Yeah. 100% agreed. So again, Mitch, thank you for your time and education around jumbo loans as we talk through, right? I know I'm learning things and thinking about, hey, if I were to move, maybe the conversation around jumbo loans should be had a little bit deeper.
For sure.
Right. So
great. Well, thanks again for having me. It's always good to join you and see you on camera and then in person the next day. So see you soon. And thanks again. If anyone has any questions, my email address is flowing at the bottom, or they know how to reach us.
Yeah, I can get that flowing right back there. So it's Mitch@thefriedmangroup.net. So reach out to Mitch with specific questions on that for anything mortgage lending related. Yep. You know, he's a fantastic resource. So, all right. Well, Mitch, tomorrow is St. Patrick's Day. So enjoy however you choose to celebrate St. Patrick's Day.
Thank you. And you as the same.
We'll get a chance to come back with next month's topic and looking forward to it.
Me as well. Thanks again. We'll talk soon.
All right. Thanks, Mitch. Be well.
You too.